For most of his career, Warren Buffett, the world's most famous investor, built his empire by avoiding tech stocks. He called them unpredictable and outside his circle of competence. He bought what he understood: banks, insurance, and soda. So when a recent filing revealed his company, Berkshire Hathaway, sank a stake worth over $4 billion into Google's parent company Alphabet, it turned heads all over Wall Street. This wasn't a small speculative bet. This was a monumental shift. It was Berkshire's first ever direct investment into Google, and it was the headline purchase of the entire quarter. Sure, Berkshire has a massive holding in Apple, but a direct buy into Google? That's new. This move is so significant because it appears to challenge the very rules that made Buffett a legend. But what if it doesn't? What if this isn't Buffett changing his strategy, but a sign that Google has finally changed into the perfect Buffett stock? Today we're going to break down the core reasons why Buffett's legendary value investing strategy now perfectly aligns with Google's business. We'll decode the numbers, the strategy, and the psychology behind one of the biggest investment moves of the year. The first and maybe most human reason for this investment is about correcting a mistake, a huge one. For years, Warren Buffett and his late partner, Charlie Munger, publicly admitted that not investing in Google was one of their greatest errors of omission. At the 2019 Berkshire Hathaway annual meeting, they were blunt, admitting they screwed up by not buying Google shares early on. This wasn't just hindsight. They had a front row seat to Google's dominance. One of Berkshire's biggest and most successful investments is the insurance company Geico. Buffett witnessed firsthand as Geico poured millions of dollars into Google search ads, paying what he once described as $10 or $11 a click. He saw the incredible, undeniable power of search advertising, sparking massive sales for his own businesses. They had direct proof of the business model's brilliance, watching money flow from their own companies straight into Google's pockets. Still, they failed to make the leap from being the customer to being the owner. Buffett's regret wasn't just about the stock's meteoric rise. It was about missing a business whose value was being proven to him every single day. So this purchase isn't just a new investment. It's Buffett finally acting on an insight he's had for years, making this move one of the most personal and calculated decisions in Berkshire's recent history. Now let's move from psychology to strategy. The cornerstone of Warren Buffett's philosophy is finding companies with a durable competitive advantage, or what he famously calls an economic moat. A moat protects a business from competitors, allowing it to earn high profits for decades. For years, Buffett felt tech companies lacked these moats because the landscape changed too quickly. But Alphabet in 2025 is a different beast. It has built not one, but several of the widest moats in modern business. First, and most obviously, is Google Search. It's become a utility, the default entry point to the internet for billions. It isn't just a popular product, it's a verb. Its dominance is so ingrained in our behavior that it creates a self-reinforcing cycle. More users lead to more data, which makes search results better, which attracts more users. It's a fortress that no competitor has come close to breaching. Second, there's YouTube. YouTube isn't just the king of online video. For many, it is online video. It thrives on a colossal network effect where creators go where the audience is and the audience goes where the creators are. This gravitational pull is almost impossible to replicate, creating a content library so vast that it's an advertiser's dream. And third, there's Android. Google's operating system runs on the vast majority of smartphones worldwide, creating an entire ecosystem that locks in both users and developers. These three platforms form a digital empire. They're so dominant and integrated into daily life that they even look less like fleeting tech products and more like the timeless franchises Buffett has always favored. The company has proven its durability, passing Buffett's decades-long test of predictability. Even with a world-class moat, Buffett won't invest if the numbers don't work. He looks for financial fortresses, companies that are incredibly profitable, don't carry much debt, and use their cash wisely. When you look under the hood, Alphabet checks every box. Let's start with profitability. Alphabet is a cash machine. In 2024 alone, the company generated a net income of over $100 billion. Buffett loves companies with a high return on capital, and he typically looks for a figure consistently above 15%. Alphabet's 10-year average return on capital is nearly 20%, and its recent performance is even stronger. This tells him that management is exceptionally skilled at turning profits into even more profits. Next is debt, which Buffett famously despises. Alphabet's balance sheet is a fortress. While the company recently took on more debt to fund AI infrastructure, its cash position is so strong that it could pay off its obligations with ease. This provides a massive margin of safety that insulates it from economic downturns, a classic Buffett requirement. Finally, there's the price. Buffett famously says it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. While Alphabet's stock has had a strong run, its valuation remains reasonable. It trades at a lower forward price to earnings ratio than peers like Microsoft or Nvidia, making it a perfect example of buying a wonderful company at a fair price. Before we get to the final and perhaps most important reason that looks to the future, if you're getting value out of this breakdown, take a moment to hit that like button and subscribe. We decode the strategies of the world's greatest investors every week, and your support helps us create more content just like this. The final reason for this investment isn't about the past or the present. It's a calculated bet on the future. This purchase is a massive vote of confidence in Alphabet's position in the next great tech wave, artificial intelligence. This is Berkshire buying a ticket to the AI revolution, but in a uniquely Buffett-like way. While headlines are dominated by chipmakers like Nvidia, Berkshire's investment shows it sees Alphabet building its own powerful AI moat. The company is a leader in AI research with its DeepMind division and Gemini models. But the real strategic genius here is the company's vertical integration with its own custom-designed AI chips, known as Tensor Processing Units, or TPUs. For nearly a decade, Google has been perfecting these chips specifically for its AI workloads. This is a massive strategic advantage. While competitors are reliant on buying expensive, often supply-constrained GPUs from third parties like Nvidia, Google controls its own destiny by designing its own hardware and software to work together perfectly. It can achieve levels of efficiency and cost-effectiveness that are incredibly difficult for others to match. This insulates Alphabet from supply chain bottlenecks and creates a durable long-term advantage in the race for AI dominance. In essence, Berkshire isn't just betting on a flashy AI app, it's investing in the fundamental infrastructure of the AI economy. Just as it invested in railroads and energy pipelines in the past, it's now investing in the digital pipelines of the future. So why did Warren Buffett buy Google stock? When you piece it all together, the picture is crystal clear. This wasn't a betrayal of his principles, it was the ultimate application of them. First, he corrected a painful, decade-long mistake he watched unfold from the front row. Second, he bought into a business with unshakable economic moats in search, YouTube, and Android. Third, he found a financial fortress that meets his strict criteria for profitability, low debt, and a fair price. And finally, he made a strategic bet on the future, investing in the core infrastructure of the AI revolution through Alphabet's unique, vertically integrated approach. The Alphabet investment proves that the core tenets of value investing, finding wonderful businesses with durable competitive advantages at a fair price, are timeless. But it also shows that even the world's greatest investor is willing to evolve. This move wasn't about Buffett becoming a tech investor, it was about Alphabet becoming a Buffett company. What does this massive investment tell you about the future of big tech? Let me know your thoughts in the comments below.